Good afternoon, everyone, and welcome back. This is Daily Trading Analysis with a quick market update for today, Monday, 1st of July. We are starting a new second half of the year, the first month of the second half of the year, starting the week, and also a short week. On Wednesday, we have an early close, and also Thursday, 4th of July, we have bank holiday. Markets will be closed. So this first week of the second part of the year, starting the quarter, starting the week, starting the month, starting everything, we have to really be careful. Because if you didn't watch my video on the weekend, please go ahead. I'm going to link that in the upper right corner for you to have quick access. I really recommend that because things have changed. Things have changed. And we are seeing that already in price action, but also on the data. Today, we got the S&P Global Manufacturing PMI and ISM Manufacturing PMI, and there's a lot of weakness. And I say that because weakness is pretty good for inflation. So the Global Manufacturing PMI final for June came 51.6, a little bit lower than 51.7, higher than the previous one. This is already good. But the ISM Manufacturing PMI is the thing that I would like to bring to your attention, because remember that below 50, it's contractionary, and that's what we are looking for. Both readings in the ISM for both PMI and employment came below 50. One of them was above 50. We were expecting 50, and we got 49.3. So lower than expected, and also the PMI lower than expected, and also below 50. And that's contractionary. That's good for long-term inflation. At the same time, ISM new orders and prices came lower than expected and lower than before. Look at these, the prices for manufacturing, 50 from 57, we were expecting 55, and we got 52, a big decrease. In the new orders, that's pushing higher from 45, we were expecting 49, 49.3 is the actual. This is good because it looks like new orders is demand. So as you can see, we are seeing manufacturing slowing down, entering contractionary territory, and also prices cooling down, and new orders remain on the demand zone. That's pretty good in combination, because that's the projection, that's the expectations from the Fed. That doesn't mean that markets like this. Markets want growth, higher prices, demand, employment, manufacturing. Markets want money. And that's tricky because at the same time, we have the Fed pushing to cool down the economy. So actually, good news is bad news for the market right now. And one of the things that one of the places in which we are seeing that, it's in the inverted yield curve. Let me just go straight into that, because for starters, basically, this is the difference between the 10-year long-term yield and 2-year short-term yield controlled by the Fed. The theory has that this should not be below zero. This line, blue dot line, is the zero, and we've been cooling down since the end of the pandemic from 2021. We entered contractionary territory, and we were inverted since basically the entire 2023. We pushed because we started to see how the Fed ended the push on interest rates. But as you can see, at the same time, we are seeing the long-term yields, in this case the 10-year yield, skyrocketing higher. 1.89, we are pushing the long-term yield, but the short-term yield is not pushing that much. That's why we are pushing the inverted yield curve into an inversion towards the zero line up here. Why we are worried and concerned about the uninversion? Because 100% of times when we uninvert and we go through the 0%, a recession is called, and recession is like the, the, the hell for the markets. We don't want that because growth slows and we start seeing pullbacks and basically deflationary and the economy going down in terms of market. So these last 4 days, we've been seeing a huge push into an inversion. And that's concerning because something has changed in sentiment. Treasuries, which they were a pretty easy play into the an inversion and the lower interest rates, look at this flash. And this has just started right now at the end of the last quarter, last first half of the year. We are now starting the new second part, a new quarter, a new month. It's starting July, summertime, and we are just seeing this. Let me tell you, I'm quite worried because dollar keeps going higher. Dollar keeps pushing, yields keep pushing, and the inverted yield curve, it's strongly pushing into an inversion to recession territory. I have an alert up here. I think so. Let me just check real quick. Okay, so it just went out. So let me just put an alert here because I want to keep tracking this. That's one alert, and the second one is going to be this level, which we have not seen since 2023. The entire 2024, we've been ranging here. As you can see, we have a wedge here, and we suddenly have pushed higher. So we have to pay attention to this. Don't forget about this inversion because it's crucial for the long-term health of the market. Now, in terms of technical analysis, I'm going to briefly explain why I'm still super bearish. The first sign of cautionary pressure is these two topping tails on the NQ. We have strong volume up here and we were below point of control right now. We have a second point of volume down here, and basically it's low 19,000s. So from there to from where we are right now to where I actually think we are going to pull back, it's more or less between 4 and 5% pullback. And we are going to see how both the 20-day moving average and the 45 are going to be above the price if we go lower. So really careful because we are right now with a lower high potential. If we see markets approaching 19,800s, and today it's basically a whole day, but I think we are going to see price moving lower in this short week. So be really careful if we start seeing this pivot right here being crossed down and we start seeing this fair value gap start being attacked like this, because the next stop would be 19,300s up here, and then we have more volume below that. So really careful. The 1 minute today is just chop and chop and chop. I was actually waiting for this liquidity to be taken. In the weekly recap on the weekend, I told you about this. And then I tried to find some bottom here, but my setup was not complete. This was the last liquidity that I was watching. We got the manipulation move, but this open fair value gap was never immediately tested. That's what I wanted, into a breakout of this descending pattern. We actually tested lower later on, but I just don't want to trade this. This is just too dangerous. It's not as that the same quality of setup, so I will just sit in tight. And I didn't trade today. Today's price action is just garbage. As always, we have Tesla 6%. We have Nvidia 0.50 after a big sell-off into the open. Banks are mixed. So as always, looks like the Nasdaq is nothing without Nvidia actually pulling. If Nvidia goes down, Nasdaq is starting to look super bearish. And then when Nvidia opens up, then we see choppiness. So why the hell are we trading this? Well, I think we need news. We need more data. I think after the data, people started to look for some kind of concerns about recession and lower productivity, lower growth, and things like that. Remember that markets only want growth. It's not the personal economy, it's not households economy. This is in another world economy. Normal people economy is not the same as Wall Street's market. So we want growth. And when the data today showed that we were slowing down, initially market reacted to the downside, and now we are somehow trying to push higher, but we are not moving. The ES is basically flat. It's looking pretty bearish right now. I mean, nothing else. Patience. Now that we took the liquidity down here, I was expecting to really go even lower to last week low, which is this blue dot line at 19,700. So we never tested that, but I suspect that we are going to test this and perhaps continue a bit higher into a rejection lower, because we have a lot of resistance here, inverse fair value gaps, and the range between here and here. I think this is just shorts willing to add into a move lower. So this is something I will be watching. If this does not happen, then perhaps tomorrow I will try to look for some longs into the retest of this big candle from last Friday. But until then, I'm still bearish. I'm super cautious because we just started seeing the inversion in the yield curve, dollar and yields pushing, and I mean, there's strong pressure, strong volume pushing to the downside, and I don't want to dismiss that. So be really careful, because the bias on Nvidia and AI is still there, the FOMO and hype is still there, but I think big players are starting to position more aggressively into the downside. Take your time when taking trades. And that's all from my side. As always, thank you for your time. If you found this video useful, please give it a like, subscribe to the channel. I upload videos like this one every single day for market forecasts, market updates, and market recaps. Remember that I also upload the weekly recap. If you haven't checked that out, please go ahead and check that out. I upload that on Sunday. To be prepared for this week, which is a short week, so be really careful. More than ever, discipline, patience, and risk management are key for your success. Stay safe, everyone, and see you tomorrow.